Ladies and gentlemen, good day and welcome to the Icra Limited half-yearly FY2024 Investor and Analyst Conference Call hosted by Icra. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone phone. Please note that this conference call is being recorded. Joining us today from the management side, we have Mr. Ramnath Krishnan, Managing Director and Group CEO, Icra Limited, Mr. Venkatesh Viswanathan, Group Chief Financial Officer, Mr. L. Shivakumar, Executive Vice President, Business Development and Chief Business Officer, Mr. K. Ravichandran, Executive Vice President and Chief Rating Officer, Mr. Shubham Jain, Group Chief Strategy Officer, and Mr. Jayanta Chatterjee, MD and CEO, Icra Analytics, to discuss the performance of the company during the call, followed by a Q&A session. Before we begin today's conference call, I would like to remind you that some of the statements made in today's conference call may be forward-looking in nature and may involve some risks and uncertainties. Please refer to slide number 20 of investor presentation for detailed disclaimer. Icra or any of its subsidiaries or the directors, officers or employees of Icra or its subsidiaries shall have no liability whatsoever for any loss howsoever arising from any forward-looking statement or use of the investor presentation or its contents or otherwise arising in connection with this conference call. Now I would like to hand over the call to Mr. Ramnath Krishnan, Managing Director and Group CEO, Icra, to commence the proceedings. Thank you and over to you.
Thank you, Zico, and good afternoon, everyone. Very warm welcome to Icra's first half FY24 Investor and Analyst Connect. Let me provide you with broad highlights of our financial performance in the first half of this financial year. The ratings business delivered a strong revenue growth of 11.8% year-on-year, and our subsidiary, Icra Analytics, delivered a growth of 4.4% year-on-year. Overall, the top-line growth was at 8.6%, reflecting in a robust PBT growth of 17.6%. Icra Ratings revenue continued to grow despite headwinds in the bond market and in the bank credit market. Icra Analytics business continues to be one of the strong pillars for growth and diversification as we continue to invest in critical partnerships and infrastructure to accelerate growth. We continue to stay focused on enhancing our technology footprint to better serve our clients and to drive growth. I'm excited to inform that we have recently entered into a definitive agreement to acquire a majority stake in D2K Technologies India Private Limited. D2K is an established provider of software solutions to banks and other financial institutions. The proposed acquisition, subject to closure of customary conditions, is in line with Ikra's growth and diversification strategy and will enable Icra to accelerate growth in the risk and analytics space. Other highlights for the first half include: number one, appointment of Mr. Jayanta Chatterjee as the MD and CEO of Icra Analytics Limited. JC, as he is commonly called, will be responsible for shaping business strategies aligned with the group's objectives, product and revenue diversification within Icra Analytics, and business transformation. JC has been a part of senior leadership in Icra over the last 28 years in a number of different roles. Secondly, we have recently applied to SEBI for license to commence ESG ratings business. This is consistent with the framework announced by SEBI in the early part of this year. So at the present time, the approval from SEBI is awaited. Thirdly, Icra is now part of the MSCI India Domestic Small Cap Index. Coming to the outlook for the rest of the year, domestic economic activity witnessed a healthy, albeit uneven momentum in Q2 of this financial year. While there was an improvement in urban consumer confidence levels, with continuing demand for contact-intensive services, the demand for goods was mixed, as were the trends in private sector investment activity. There was an encouraging front-loading in capex by the Government of India and the states, even as we remain circumspect that momentum could slow as we approach general elections. Further, an uneven monsoon, external headwinds, and resurgence of geopolitical tensions pose some risks. Icra continues to project FY24 GDP growth at 6%, with risks evenly balanced. Finally, in terms of flow of events, we will cover the group financial performance, overview of our ratings, analytics businesses in that order, and then open it up for Q&A. I also take this opportunity to wish everyone here a very happy Dussehra, Diwali, and a prosperous New Year in advance. I will now hand you over to Mr. Venkatesh Viswanathan, our Group CFO, to talk you through the first half performance in greater detail. Over to you, Venkat.
Thank you, Ram. Hello, everyone. I will be covering the financial section of the presentation, starting with Q2 FY 2024. Consolidated revenue from operations for the quarter increased 6.4% to rupees 104.9 crores. Icra Ratings revenue grew by 7.8% despite headwinds in the bond market and bank credit market. Securitization market continued its growth trajectory and saw a strong pickup in volumes in the current quarter. Overall expenses increased over previous year on account of salary cost and technology investments. Profit before tax for the quarter was rupees 47.3 crores. For H1 FY 2024, consolidated revenue from operations increased 8.6% to rupees 207.6 crores. Icra Ratings grew 11.8%, whereas analytics growth was 4.4%. The overall growth for H1 was positive for bond issuances, bank credit, and securitization market, which reflected in a robust performance for rating business. Icra Analytics growth was led by knowledge services. Overall expenses increased over previous year on account of salary cost and technology investments. Profit before tax increased 17.6% to rupees 97 crores. That was the update on the financial section. Thank you, and I now request L. Shivkumar to take over the balance part of the proceedings.
Thank you, Venkat. Good afternoon, everyone. I am Shivkumar and I head the business development function for the ratings business. I will talk about the rating business in two parts: the business environment that we have seen in H1 FY24 and the outlook for the same for the rest of the current financial year. Firstly, the business environment. In H1 FY24, bond issuances and bank credit showed a good growth. Bonds were up by 43.5% year on year, and bank credit outstanding at the end of September grew by 6.5% over that in the end of FY24. This growth really came about in Q1, helped by a transient dip in bond yields and a good demand from the industries and services segments for bank credit. Q2, however, faced headwinds in both the bond and the bank credit segments, the former due to volatile yields and the latter due to tight liquidity. RBI had imposed incremental CRR in the August monetary policy, as you would all recall, which got reversed subsequently though. CP outstanding too saw a good growth in Q1, but a sluggish Q2. The sluggish credit market of Q2 was far outstripped by the surge of Q1, to support the H1 growth numbers. Securitization volumes, however, were strong in Q1 as well as in Q2. Need for diversified funding avenues due to tighter liquidity, need for cheaper funds, which was made possible with credit-enhanced cherry-picked pools, supported securitization volumes. Couple this with good investor appetite for pools from NBFCs, both large and small. This helped the securitization business. Ikra's revenue growth for both Q1 FY24 and Q2 FY24 reflect these trends observed in the bank credit and bond market, with the swings somewhat moderated for Icra by its consistent market position in securitization segment. I will now move to the outlook. We do not give future guidance. Government infrastructure spend, working capital requirements from industry, and demand from NBFCs will continue to spur growth. These would, to some extent, get tempered by the prevailing credit market conditions, including uncertain yields and tight liquidity, the latter being a result of attempts at inflation management. Overall, for the rest of FY24, we believe that credit offtake would happen on expected lines. Thank you. That's all from my side. I would now hand you over to K. Ravichandran, our Chief Rating Officer.
Thanks, Shiv. Good afternoon to all the participants. Over the next few minutes, I'll be covering the performance update on rating operations. We finished the off-year ending September 23 with further improvement in the rating accuracy metric, namely average default question or ADP. We ended the off-year with an ADP of 95.1% as compared to 93.3% as of FY23 end, and long period average of 76%. The higher the ADP, the more accurate are our ratings collectively. Other rating accuracy metrics, namely cumulative default rate and rating stability, have also seen significant year-on-year improvement. You can refer to our website under rating performance for granular details. It's our endeavor to maintain such rating accuracy levels in the coming years. Moving to other performance trends, in H1, the proportion of entities whose ratings were reaffirmed or remained unchanged was at 81%, closer to the long period average of 80%. The credit ratio of Icra assigned ratings at 2 times in H1 reflected the persistence of the momentum in rating upgrades and continuation of the trend seen in the previous 2 fiscals, even as the net upward pressure on the ratings was seen to be on the path to normalization. In a similar vein, the upgrade rate of Icra assigned ratings moderated to 14% in H1 after peaking at 19% in FY22. This reflects a normalizing upgrade momentum post 2 consecutive years of tailwinds in the operating environment that had followed the trough induced by the COVID-related pressures on credit quality. Likewise, the downgrade rate is seen to be on the normalization path and reached upwards in H1 vis-a-vis the previous 2 fiscals. Icra continued to expand its research and initiate strategic market outreach and events in Q2. The company hosted a high-profile market event on electric vehicles and renewable energy in New Delhi, where Sri R.K. Singh, Honorable Cabinet Minister for Power and Renewable Energy, shared his insights as the keynote speaker. We also organized a joint conference with Moody's with the theme India Credit Conference. Both the conferences saw high-quality panel discussions, resulting in positive feedback from the audience. The company initiated 11 webinars on various focus sectors and participated in 20 market events as thought leaders during the quarter. Some of the notable webinars were on banking, NBFCs, pharma, and outlook for FY24, which saw overwhelming participation from the investors, lenders, and industry participants. With these remarks, let me hand over the floor to Jayanta Chatterjee, MD of Icra Analytics Limited. Thank you.
Thank you, Ravi. Good evening, everybody, and I shall take the opportunity to share an overview of the business of Icra Analytics Limited, IAL for short, which we refer to as the non-ratings business for the group. For each of the 3 businesses in IAL, I will cover the current environment in H1 FY24 and also briefly touch upon the outlook. Knowledge services is our largest vertical, and in H1 FY24, it continued to drive growth for analytics, Icra Analytics. Although inflationary pressure continued and geopolitical concerns remained unabated during this period, we were able to further expand our value-added services for our anchor client. The outlook for the business remains strong, driven by trend towards digitization and AI-driven automation. We expect that focus will remain on business transformation, data analytics, and technology services. Our clients' businesses would be driven by refinancing requirements post high volume issuances in the pandemic run, which is expected to also benefit us in turn. Moving on to our second business vertical, which is market data, the regulatory push for risk management, data transparency and reporting continued to drive volumes in H1 FY24. We expanded our coverage during this period to provide newer services like stress testing and also enter into tie-ups with global data providers such as FactSet, Bloomberg, and ICE to service other large markets, including global markets. The outlook remains robust, driven by trend towards cloud-based information tool and related data products and more of value-added services rather than pure data. This is expected to drive consolidation of our services and products. Coming to our last business, which is the risk management business, it saw growing demand for risk solutions from banks, financial institutions, and also the NBFC segment in H1 FY24. As regards outlook, we expect demand in risk management vertical to be driven by emerging credit decisioning and monitoring norms based on more real-time data, expected credit loss provisioning norms for banks as and when the same is announced by regulator, and increased focus by large banks to integrate various systems and have a common data and analytics platform. This is the update from Icra Analytics side. Thank you all very much, and I now hand over the call to the operator.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Yeah, sir. Thank you so much for giving me this opportunity. Congrats on good performance. So my first question is on the domestic ratings growth. So we have seen sequentially some moderation in growth. While you've outlined the macro reasons behind the same, but can you give us more color whether there were any reasons specific to Icra, like any market share movement, any pricing movement, any change in segmental mix, etc.?
Yeah, I will respond to that. I am Shiv Kumar here. Yes, you are absolutely right, and we did point out the macro movements which had a bearing on our revenue for Q2, both on the bonds as well as on bank credit. So essentially, it has indeed been the market environment which had a deep influence on our revenues. If you look at our own position, I would say by and large our position remains stable. Our strategy, our approach also remains stable, which is we are very mindful of what kind of business to pick up, in the sense the business has to be profitable enough. And as we've been maintaining over the last couple of quarters, our trust is focusing on growth segments, which is infrastructure and NBFC, where we have by and large maintained our share. And these are the segments where we've also been endeavoring to push our yield up, which is in line with the premium position which we enjoy in the debt market segment specifically, where we are surely one of the preferred rating agencies. So I would say by and large our position is stable and our approach too has been very stable.
Got it, sir. So how should we look at, I know that you don't guide specifically, but since we have seen some choppiness, I mean, the first quarter the revenues grew by 16% Y&Y, the second quarter the revenues have now grown by 8%. Do you see more hangover because of tighter liquidity conditions? I mean, I think you spend it out, but how should we pivot our growth expectations in the future?
See, I would say you look at FY24 as a whole. As I mentioned in my remarks, that we are on track, and our expectation of credit pickup, which is the same as we mentioned in the earlier investor call. To some extent, you are right. Q1 saw a little bit of front loading, particularly because there was a transient dip in bond yields. So most borrowers would have made good use of that, which possibly the one way of looking at that is that got reflected in some bit of a dip in Q2. I would say look at FY24 overall. We still maintain that the credit offtake should happen on expected lines.
And Rajiv, just to add, probably maybe to look on a standalone Q2 basis, maybe not be a fair representation. H1 would be a better representation than a Q2.
Got it. And second question is on Icra Analytics and specifically knowledge services. Now, this is the second consecutive quarter where we have seen moderated growth. And when I say moderated in the context of the way we grew in the past 2 years, the current growth rates are much lower. If you can spell out what has changed in the environment, I think macro you've given out that spending has slowed down. But specific factors to us, because we source a bulk of this revenues from our parent Moody's, so we can highlight few specific reasons for this lower growth coming, and when can we expect this to revive?
Yeah, I'll take that question. So you're right, there has been a moderation in the growth rate that you have seen, and as we have mentioned in our call also, the reason primarily is the global slowdown that we are seeing, and that is having an impact in terms of the way the business is flowing. We are working on two levers. One is increased value-added segment, and that is something that we keep sourcing as and when we interact with our bank. And whenever we get that opportunity, we do proof of concept, and those are the ones which will move it further into the value-added domain going forward. We do expect that the overall macro overhang of global slowdown will continue for some time, given the uncertainty. But this strategy is something we expect should play out as we move along.
Great, thank you. Just lastly on broader question on margins. Now that we are now set on the revenue growth run rate that we are looking forward, what are the margin levers available for us to pull up margins from where we are over the next 4-5 quarters?
Sorry, is this question for Icra?
No, aggregate. I mean, I would say it's an aggregate question. So you can just highlight margin levers both on the rating side as well as on the analytics side.
Venkat, would you like to take that?
I will pick this up. See, from a lever perspective, I think if you look at the analytics side, it is largely the headcount. I mean, there could be some lever in the way we look at our utilization. So there will be some level playing that we'll have on the headcount if, we are not able to get an uptick on the business. As far as the rating side is concerned, I think it is a level play. I mean, it's largely linked to revenue. But having said that, the kind of investments that we are looking in technology, I think that will eventually get us an operational efficiency and process efficiency both.
Rajiv, Ramnath Krishnan here. I mean, if you look at the margins, you have to look at it, obviously, at a business level. If you look at ratings, despite our continued investments, in technology and in people, we've maintained our margins, in the ratings business. And for the reasons, explained, by JC, the non-ratings business housed in our subsidiary Icra Analytics, that has seen, some dip. But as things, stabilize as we go forward, we expect, that to improve as well. And then we expect overall margins to also start improving as the benefits from our technology investments, start delivering as well.
Got it, sir. Thank you so much for answering all my questions and best of luck.
Thank you.
Thank you. Our next question is from the line of Balaji from IIFL. Please go ahead.
Good afternoon. Thanks for taking my question. I have two questions. So first is on this recent JP Morgan announcement of inclusion of Indian bonds in its emerging market index. Could you talk a bit about how this would be positive for Indian markets in general and how this would help deepen the Indian bond market? My second question is on the knowledge services segment again. So if I look at it, most of it is related to your parent Moody's, and your annual revenue run rate is somewhere around 150 crores or a little below $20 million. Now, while you have talked about inflationary pressures impacting this in the short term, shouldn't this be largely immune to macro slowdown, considering that this $200 million is minuscule compared to the segmental revenues of both Moody's Analytics and Moody's Investor Services, both of which I understand are north of $2.5 billion of annual revenue. And a related follow-up is that even if one were to assume that you are susceptible to a slowdown at Moody's own numbers, as I look at their financials, appear to have bottomed out in late 2022 and early 2023. And they have been largely recovering since. Of course, we have only one extra quarter of data, but at least that seems to be suggesting a recovery. So, how should one reconcile this and the slowdown that we have seen in the knowledge services segment? So those would be my two questions.
JC, would you like to take both?
Yeah, I will start with the second one. You're right that, on a broad level, definitely the macro should have limited impact, as you say. But nevertheless, one must keep in mind that Icra Analytics is not the only service provider to this client. There is also an insourcing which is done. So they have a center which does the similar kind of work in India, and there are also centers across the globe to which this work is outsourced. So as a result, it's a competitive business where IAL has to compete with other providers of this business. And while we have been able to maintain our position in this market, definitely our stability of our processes and the way in which we have scaled up the business is testimony to the fact that we have been able to derive a lot of efficiency, which is also driving business this side. But I would also emphasize that it's not like every business from Moody's would come to us, so there is a competition there as well. So that is something that would explain the way in which the trends that you are seeing. Coming to your other question regarding inclusion of India in the JP Morgan Emerging Bond Market Index, I think starting from June, this is to an extent of 10%, this inclusion is expected to drive more and more investment into government security bonds. We are already seeing that some discussion has started around this factor, and we expect that as we move into the next year, that is FY25, there should be increasing interest in government securities and government bonds, investment in Government of India securities, which should definitely help our own bond markets, grow from the way they are at the current moment. So this is a positive. The overall 10% may not be reached immediately, but it will scale up over a period of time. So we expect that gradually, as we move into the third and fourth quarter of FY25, this trend should be more prominent.
Yeah, Shiv, anything further to add?
Just to add to that, we've always been saying that, the GSEC or the government borrowings tend to crowd out the corporate bond market in India. So this is one factor which will give some headroom for development of bond market, and over a period of time, this should definitely be helpful to the development of bond market in India.
Okay, thank you. So just basically on the first response on the analytics, so if I understood it right, since the macro conditions are a little unfavorable, it would be fair to state that Moody's has also insourced a little bit of work, right? Did I hear you right, in addition to the other competitive factors that you just outlined?
That's correct. That's correct, Balaji.
See, to some extent, Balaji, what actually gets diverted to us, the service provider, is a function of the business flows that Moody's themselves, see, globally. If those business flows actually slow down, then what gets actually diverted to us or outsourced to us also will reduce. So it's a function of the throughput that they see and what gets actually diverted towards us. So it's a leverage play on their revenue or their business flows as well. So if they are facing headwinds in terms of business flows, then naturally the level of business that actually gets diverted to us will get impacted as well to some extent. But obviously it's something that we hope and expect to sort of get back to near normalcy sooner than later.
Got it. This is quite helpful. Thanks and all the best.
Thank you.
Thank you. Our next question is from the line of Varun Bang from Bryanston Investments. Please go ahead.
Yeah, hi. Thanks for the opportunity. Just a couple of questions. Firstly, on the rating business, is it possible to get some insights on how the pricing works when any client comes for enhancing its bank loan facility? Hypothetically, let's say if there is 50% enhancement in the value of rated debt, how much would that translate into incremental revenue fees for us? I'm sure there'll be multiple angles to look at it, but how should one look at it? Can you please help me understand this aspect?
Yeah, see, at a very broad level, the pricing is a function of the volume of debt being rated. This holds true for bank credit, that is the bank loan ratings, as well as for the bond ratings, including commercial paper, etc. So that broad principle holds. So whenever an existing entity comes to us with an enhanced requirement, there is an initial rating fee and an annual surveillance fee applicable on the enhanced fees as well. So that's the broad principle which holds true.
Okay. And is it possible to get revenue split between, in the rating business again, between large corporate and MSME?
The rating split between what? The fresh and the surveillance?
No, large corporate and MSME.
Okay. To maintain parity of information, we don't disclose that specifically, so we can't give that information.
Okay, no problem. But let's say if large corporate, it has almost 74% share in the total industrial credit, would that be, is that ballpark same holds true for us on the dealer side?
No, it's difficult to say that. See, we are looking at RBI's segmental credit to arrive at this number. See, as far as we are concerned, our overall revenue mix comprises debt market ratings as well as bank loan. Now, smaller entities mostly would be rated for bank loan. The larger entities would be rated for both debt market as well as bank loan. So we've not looked at it the way you addressed, or rather you have had a look at that particular number. So difficult to comment on that ratio as such.
But I can respond to your question slightly differently at an industry level. At an industry level, if you look at the composition of value of volume of debt rated, typically your market instruments would account for a fairly significant portion. When I say a significant portion, I'll say upwards of 60%. So 65-35 would broadly be the mix between your market instruments and your bank borrowings. So the bank borrowings will be smaller ticket, relatively speaking, and the market instruments will be larger ticket deals.
Got it. Thanks. Second one is on the ESG rating providers. The ESG providers are now regulated under provisions of CRA regulations, and most of the rating companies, including us, have incorporated a separate subsidiary. What, in your opinion, is regulators' thought process here, and what is our sense of the opportunity, and how do you think this should evolve?
So sorry, I didn't get your question. Can you repeat it, please?
Yeah, so this is on the ESG rating providers.
Got the first part. Your question was, what is the regulator?
What is the regulator's thought process here, and what is your sense? How could it evolve? And I think the framework is quite comprehensive. Would that mean the industry would have decent opportunity in this space?
Yes, see, I think it's still early days yet. At the moment, in fact, what has been prescribed by the regulator is just a framework within which every ESG rating provider, has to operate. But I think the way to look at it is not to look at this in isolation. You will have to look at ESG as a whole, as an area, which can be addressed not necessarily through the ERP company, but through our risk analytics franchise as well. So we will be looking at it holistically. So it remains to be seen as to how it plays out, but generally speaking, given the attention that is receiving from the regulators, from international investor community, etc., so we expect this to actually evolve, quite considerably over time. But I think it will be a journey.
Okay, got it. Just last one. If we see initial years of Moody's post-separating from Dun & Bradstreet, for many years they heavily bought back shares from the market and eventually, forfeited a large chunk of share capital base. And this over a period of time had, significant impact on earnings per share. I would like to hear your thoughts on the same. Are we open to look at such options? I mean, Moody's current holding in our company can give us liberty to look at such options. Can you please share your thoughts?
Yeah. See, one of the issue is we cannot comment on this because it's a UPSI information. So unfortunately, we will not be able to comment on this.
Sure. Thanks.
Thank you. Our next question is from the line of Nitesh Rege from Chris Capital. Please go ahead.
Hi, sir. Thank you for the opportunity. Just following on the question from the earlier participant, what would be the current market size of this of the ESG rating segment market?
See, at the moment, it has to essentially be a function of what the regulatory expectations are and how the regulator expects these to be managed. See, at the moment it's not mandatory, right? So it is not essential for any entity to get themselves rated, from an ESG perspective. So there is obviously, a voluntary solicitation that takes place, but that is purely voluntary. So therefore, to determine the market size from the point of view of how much of this can be monetized, I think it is still, difficult to determine, in a country like India. You can probably, hazard a guess to determine what the addressable market might be in terms of how many corporates and based on the size of their debt, might have ESG implications. But how much of that is likely to be monetized or could be monetized is difficult to tell because at the moment it's not actually mandatory. So that's why I said, this is an area I think that will evolve over time. So it is an interesting area, it's very topical, receiving a lot of attention. I think there are baby steps that are being taken, but how it will evolve as a business proposition, I think only time will tell.
Okay, thank you. And could you highlight who are the other players in this segment?
See, at the moment, you have obviously a few international entities like MSCI and you have Sustainalytics. And locally, at the moment, obviously there are voluntary, gradings, provided, by a few Indian entities. But internationally, essentially, is just a, handful of them. And this is outside of the ratings community internationally. Obviously, our parent, Moody's is involved in it, and so are some of the other international credit rating agencies.
Okay, sir. And one more thing. So we have substantial amount of cash in our balance sheet. Could you highlight any capital allocation plan?
So we constantly evaluate our capital allocation, and you would have seen in the past that based on that evaluation we have increased the dividend payout. Obviously, we have also had a recent announcement about the acquisition of D2K, and we assure you that we will continue to relook at this on a periodic basis and ensure that we maximize value to our stakeholders, all stakeholders.
Could you also highlight the synergies you're looking at from this D2K acquisition, and any thoughts on it?
Shubham, would you like to take that?
Yeah, sure. Yeah, thanks for your question. So this D2K acquisition is in line with our growth and diversification strategy. So overall, Icra revenue, is well diversified currently between ratings and research and analytics. Now, this acquisition of D2K further helps us to accelerate growth in risk and analytics space. So what we see is that Ikra's brand, sectoral expertise, existing client engagement, a very strong in-depth entrenchment in BFSI, coupled with D2K's domain and technology will create significant value to clients in the risk and analytics space.
And how large is this segment, and who are the other major players?
So this segment, if you see, is very large, and there are a lot of like fintech companies also who are growing very, very rapidly in this risk and reporting and compliance domain serving the BFSI. So there is no like sizing as such. There are no reports, but market remains very large. We have similar products like EWS, which is the flagship product of D2K, with the brand of Prispac. So we have competing products from Repository or a CrediWatch, Top 42, etc.
To answer your question a little differently, I mean, see, the addressable market is essentially the entire lending community. So that's your entire BFSI space, and that is again constantly expanding. And naturally, this is an area that's constantly and rapidly evolving. There are a number of new regulatory requirements that actually keep coming into play. So therefore, these analytics tools will also have to be, up to speed in keeping with the market developments. So I think as an opportunity, I think it's enormous, and I don't think, that's going to be a limiting factor at all.
Okay, sir. Thank you. That's all from my side. Thank you so much.
Thank you.
Thank you. Our next question is from the line of Ravi Purohit from Securities Investment Management Private Limited. Please go ahead.
Yeah, hi. Thanks for the opportunity to ask the questions. Just wanted to, get your sense.
Mr.
Yeah.
Ravi, may we request you to use your handset, please? Your voice is muffled, sir.
Yeah, can you hear me now?
Yes, that's better. Please go ahead, sir.
Yeah. So my question, basically two questions. One is, I think we mentioned about margins and we were able to kind of maintain margins, but that's like more on a YY or a quarter-to-quarter basis. But if you look at the overall rating margins profile compared to the last 10 years average versus last 2 years, we are probably at the lowest margin profile that we've ever been in our history, right? 10, 15 years of history. So we are at the bottom of that margin. So is any color that you could kind of share on where do margins go from here? Is this the new norm? Is this the new level that one should expect? Or there are enough levers for us to kind of either operating leverage, growth, or whatever that we are working with, and that we could expect some normalization of margins to happen in the ratings business. And second is this reorganization of costs between ratings and analytics that we have done, which I think we've mentioned for the last 2 quarters, I think. And also we've emphasized on this tech spends that we are doing right now. So if you could just elaborate a little bit more as to what nature are these tech spends, what is this all reorganization? Is this something that is long been needed at the firm level and we are doing now? Or is this some kind of a reorganization that we are doing? If you could just spend a little time and share some insights as to what and what are the things that we are doing, it will be helpful for us.
So the first question, which was on the rating margins.
Yeah.
I think on the rating margins as an organization, I think there is some way for us to go, and we are cognizant of the fact that the margins has to improve. So currently, I do understand that the peak margins which you are quoting, they may not essentially, what we are looking. But having said that, we are cognizant of the fact that a couple of years back, we were at 35% margin. And most of the rating business has a higher level of margin. Though we don't give any forward-looking guidance, but our endeavor is to keep on, working on operational efficiencies. There are 2 levers essentially in the rating business. One is obviously the pricing and what you call as increasing up the revenue, and the second is mostly on the cost side, which is operational efficiencies. I think these 2 are a focus area for us as a management, and we are working towards that and trying, and our aim is to improve the margins year-on-year basis. So that's what the best we can give, at least from a forward-looking basis. This is what we can answer.
So sorry to interrupt you. So the reason actually I asked that, when I look at, let's say, CRISIL from last 10, 15 years point of view, right? It's not like CRISIL has faced some immense margin drop in the last 2 years or 3 years, right? So their margins are actually pretty much at the long-term average, right at the long-term average, right? So it looks like it is a company-specific issue. So is it something that we need to solve for something, because pricing should then impact everybody else, right? Not just CRISIL, not just us alone in that sense, yeah.
No, I think when I said pricing, in the sense pricing was one aspect of it, I also did mention about the operational efficiencies, which is on the cost side. Obviously, we are working as a strategy. That's where the tech spend will also come into play. So it's not a single strategy purely linked to price. We also need to, if you ask me, go for more client acquisition. That is, so these are the two. So when I didn't especially mean that we are only looking at pricing as one of the options. So it is pricing as well as client acquisition, as well as something working towards operational efficiency. This forms a part of our strategy as well, where we actually look into all of these. We are actually working in many of these areas, and we are hopeful that we will be in a position to, move needle there.
Okay.
The second is, the second question was in terms of the allocations between the margins between the ratings and the analytics side. So what essentially has happened from the current year is we are using, and this also addresses in one way or the other when we were talking about the first question, and indirectly this addresses, we are actually enhancing the group resources to take on more responsibility, which means with the same set of resources, we will be serving, let's say, analytics or any other entities that come into play, which is what essentially has happened. So we have put a framework wherein some of the costs which were being earlier, essentially sitting in one particular entity, with a better utilization of resources, we are also passing on these costs to the other entity. So this is so at a group level, yes, I do agree that at the initial stage you will not see, because it's a net, it will not have any impact. But eventually, this will lead to with the consolidation of the corporate group. Eventually, we will see some kind of an efficiency flowing in a couple of years.
Now, just to elaborate further, the corporate functions, particularly, like your finance, compliance and legal, secretarial, etc., etc. So we had duplication of infrastructure, if you like. We had infrastructure at the parent level, and then we had similar infrastructure established in some of our subsidiaries as well. So what we did at the start of this financial year was to have agree a shared services framework where all the corporate functions are essentially managed, centrally, and to avoid, such duplication, and with a view to deriving better operating efficiencies. And naturally, this shared services framework that we got into also would result in a cost charge, being applied based on how the resources are, allocated. So it results in better operating efficiencies, number one. Number two, your segmental profitability, what is actually getting reflected or what will get captured, going forward, will be a truer reflection of the actual profitability.
Okay.
And the third was some color on the tech spends. So I think we will bucket this into 3 or 4 so that you get a clarity on where we are looking at this. So one is there is some amount of stack up or a catch up that we call, where we actually need to do an investment. So that is a component which is out of the overall scheme of things. It is small, but there is a amount involved, which would largely reflect the infosec, the controls, and those kind of stuff. The second piece of this technology investment, when we speak about, is about when we look at investing more in products or client-related, assignments or delivery, where we can enhance delivery of our products or solutions to the client. So there is a amount of investment that is happening in this bucket as well. The third bucket where we say is largely trying to, get operational efficiencies. This involves a relook at the process and automate the current process that we are, and see if we can generate any efficiencies there. And the fourth part of this investment is also a bit futuristic, where we are actually relooking at the model and see if we can adopt some of the latest technology, something like AI at a faster pace. So to address the tech spend, it's 3 or 4 areas that we are looking into it, and there are spends happening across these areas as we speak.
So would these spends be more like you spend? So if I have to share an analogy, it's like you're running on a treadmill. For you to be at the same place, you keep running, right? So are these spends in the nature of that? For us to be relevant, we need to kind of keep spending these every year, or do we actually see some monetization benefits out of these, either in the form of higher business or higher margins?
We see so one of our core strategies is to use this and obviously enhance the margin. So when we spoke about ratings at the earlier part, and we did see that, we have a journey, I think this technology investment should play a significant role in helping us, meet that journey or the margin aspiration that we have. So to answer your question, there is a fair amount of that recurring treadmill running, which is what you said. But having said that, there are something which is definitely is going to be margin accretive. But having said that, there is an amount of time that it will take, and so that is something which we have to cognizant of.
Okay, great. And so the second part of my question is basically on this the outsourcing business, the Icra Analytics part. How should or how does one kind of look at evolution of this business, right? So there was a phase where we kind of grew fairly nicely many years back. Then there was again a phase of lull where for 2-3 years we did not grow, and then again post-COVID there has been a very strong 3-year period when we virtually doubled our business in the outsourcing piece over the 3.5-year period, right? And now again we've hit like 2 quarters where the growth has kind of come off dramatically. So is it like project to project, or do you have to kind of keep looking for newer projects within the Moody's universe? And so how should, because I mean the scale is like really small even now, right? It's like aggregate basis rate is not even 200 crore per annum, right? So there is a large opportunity. So how does management look at growing this business or evolving this business over a period of time, and how should we as investors kind of assess and say that look, things are sometimes you may have a few quarters or a year or two where it may consolidate, and then you can have another leg of growth coming in from different divisions or segments. So if you can just give some color on the path to growth to this business. Right now it's like a random thing, right? Every quarter we get the number, we say we see the numbers and that's about it, right? There's absolutely no connection that we can make as outside investors, right?
No, fair question. I think there are 3 or 4 questions built into that. I'll try to answer a few, and I'll also then pass on this to JC. One is, I think, most of our business, including the rating, I think to look at on a quarter basis may not be correct. I think we should look at from a full year basis because we get a full flare of the numbers. Having said that, the last 3 years, if you look at this business, it's given a very strong growth in the last 3 years because of the reason that we did get opportunities to work on the ESG segment. So the way this business operates largely is that many times it is a combination of both. To answer your first question, this business, the growth depends on 2 parts. One is you have a very steady stream of revenues, which is what people call it as an FTE, the full-time equivalent. So that gives you a stability for the business. And the second part of this is the project. So it has got a combination. So 80 to 85% of the revenue from this will largely be on a FTA model. The second part of it, which is on a project basis, it depends upon how the projects you get or evolve, or you get it from the host company or the parent company. So that is again dependent upon one of the factors of the policy of the company, how they want to look at outsourcing. And the second is obviously the global economic factors that they are in. So the last 3 years we had a good run. The economy was doing well. Having said that, the current year, as outlined by us earlier, there was some challenge in the global economy itself, and we did see an impact of this in the projects that we have. So to answer it again, I think most of the time the question comes here: how to size or make a, create or see how this business grows in future. I think JC did cover this. We have to compete with other service providers to get business. So there is no free lunch from Moody's, and it's also perspective. It is more than fair for them to ask us to price ourselves well and be competitive. So we compete like any other service providers with them and win business. Having said that, I think we have a track record last 4 or 5 years where we have actually delivered well, and we have a continuing relationship with them, and we are confident that this will help us grow. Coming back to the next question, the forward looking is a bit tricky that we don't get into that space, but I think I have answered most of the questions. JC, you may want to add any points here.
Yeah, sure. Venkat, I'll just add a few points to what you mentioned. While the growth that you are seeing in the last 3 years has been robust. What has driven this growth and the capabilities that we have imbibed which are helping us to grow is basically very strong process capabilities in data extraction, data analysis, and also in very specific verticals of Moody's, which has helped us to grow the business. Now, as we mentioned earlier, a certain business in ESG which came to us has grown quite a lot, and that's something which has supported us in the last 2 years, I would say. Going forward, our endeavor always is to look at these kind of segments where value-added component is high. And as you know, the way financial markets are evolving, these businesses will keep coming in the fold of our client, and the way in which we can capitalize on it is our proven expertise in process excellence, which is very well recognized within the system. So I would say that, yeah, I mean, a project can have a certain volatility around the baseline of 15, but these projects we expect we should be able to capitalize on more and more as we go forward. So to answer your question, you would see certain volatility, but there would be areas where we can capitalize on our excellence, and we are very sure. Not only that, we are also looking at non-Moody's options, and we are exploring the market to see both on domestic as well as on global front as to where we can go with our capabilities in process excellence and data analytics, which can service the financial markets in US very well, and it's a question of finding and growing those plans as we move along.
Okay. Thank you so much. Can I ask one more short question?
Yeah.
So, this is basically regarding our the acquisition that we've made of D2K technology, right? Now, this is probably one of the few acquisitions we've made in a long time in the listed company, right? So, if you could just spell out or just share our strategy behind, what kind of areas are we looking, and what kind of skills are we looking to acquire skills, or are we looking to acquire clients when we do M&A, right? So in something like a D2K, is it like, will it add skills to our capabilities, or is it going to add clients, or how does, because many times it so happens that when you have a lot of cash and you get opportunities, even if the opportunity is not as attractive or as let's say profitable as our current existing business, we may still end up doing it. Does it really make sense to do it? We only know after like 3 years or 4 years or 5 years of having acquired the company. So if you could just share what goes into into our minds as to with regards to these acquisitions.
Sure. First and foremost, the first box that needs to be ticked is to see whether the business that we are acquiring or we're looking to acquire provides synergistic fit to what we do as a business and what we want to do, as a business. So essentially, to answer that differently, it has to be related to risk analytics, and which is core to our franchise. So that's point number one. Point number two, we naturally, would like to invest only into those businesses that are either profitable already or where we have a clear line of a clear visibility into when the operation might become profitable. So we're not looking to invest for the sake of investing. So it has to bring value to our franchise. It has to be synergistic to what we do at the present time, or for that matter, areas that we want to get into. So it has to be essentially at the present time, we're only looking at risk analytics as an area where we would like to expand. Naturally, when we actually make such acquisitions, first and foremost, it needs to be an established operation. It needs to have pretty good acceptability in the market, and naturally the expectation is that we will take over the customers that they have as well. And what we additionally look for is the value that they can bring from a tech stack perspective, which we can use across the board in our various group entities. So, and in this particular instance, we believe that all these boxes have been ticked, and which is the reason why we have signed this definitive agreement. But whenever we look at such opportunities in the future, all these parameters will be evaluated in detail, and only if these boxes get ticked. And of course, I'm not for a matter, for a minute, discounting the cultural fit. That's obviously very, very important. That's something that we look at as well. But these are the parameters that we will typically look at whenever we look at opportunities in the inorganic space.
Okay, wonderful. Thank you so much and all the best.
Thank you.
Thank you. Our next question is from the line of Kunal Thanvi from Banyan Tree Advisors Private Limited. Please go ahead.
Hi, thanks for the opportunity. So my question was on, I had two questions. First was on the employee cost. When we look at our employee cost, it has grown at a faster rate than our revenues, and it has been growing for a while. Can you throw some light on, what's happening there? Is it like we are restructuring our teams, or we are seeing upfronting of in terms of, employee addition, or it is normal wage hike? How do one look at the employee cost growth rate for both, analytics business and the ratings business? That is my first question. And in terms of the investment phase, so when we look at our cost OPEX, both on the technology side and employee side, overall we've seen, there's been quite a few money going behind both of these aspects, and you touched upon the technology side. But if you were to think from, the phase of the investment, where would we be Icra as a company is in the phase? Like, are we in the middle of the phase, or we are towards the end of the phase in terms of, this OPEX investment? So that, that can help us understand from the margin, incrementally how much, growth we will see in cost compared to, the revenue growth. So these are the two questions that I have.
So there were two questions. One is on the employee cost. How do we look at it? So we are pretty much done in terms of what correction we had to do last year. So if you take an H1 cost, I think it will give you a fair representation of how our costs will be, at least for a full year. I'm not saying that, from a forward-looking perspective, but I'm saying it will give you a fair representation. That was the first part of your question. That was the answer. The second part is from a tech perspective. I think we have done a fair amount of legwork. So I did mention that there are 4 or 5 buckets, and each of them are in a different phase. So to put where we are, whether we are at a starting, I would say we have reasonably spent, and from a journey perspective, it's very difficult to put, whether I am in the mid or, because there are 5 different initiatives that we are looking at it. But I would, if you really want to get a sense, I would say around 25 or 30 or 40% is where the journey has been. I'm not saying the cost, because that is an outcome of, multiple factors. But from an overall journey perspective, if that's a thumb rule, I would say I would be somewhere around 40 to 45% where we would have done the journey. There is still a journey for this. There will be some more investments which definitely will come along the process. But having said that, we are sure that these investments that we are doing, they are going to, at least in the near term, they will help us build some of those process efficiencies and help us to get those margins where we want to be.
Sure. One more question, if I can ask. It was on the knowledge services business. Like when I look at, the number of employees or the headcounts that get added, for last 6 to 8 months, we have not seen, addition in the headcount for the knowledge services business, for the Icra Analytics as a whole. While, our understanding was that that would be a lead indicator for the growth in the, entire Icra Analytics. Secondly, since we are kind of trying to scale the non-Moody's business in India and, globally also, what's the disconnect there? Ideally, should we see headcount increase in the Icra Analytics because we are trying to grow both the Moody's Analytics business and non-Moody's business in India?
So I'll take that question. So first is, I think that's from an assessment perspective, I think we have not added much incremental headcount during the year. That's a correct assessment. So as I mentioned in my earlier, conversation, that there are 2 parts to this whole business. One is a steady state of headcount, which gives you what you can call it as a run rate, fixed run rate. And the second part is a project. So in every year, what typically happens is your 80 to 85% of your revenue comes from the what you call it as a full-time equivalent or an FT. And there's a lot of leverage that we have, wherein that 15%, depending upon how the client's budget, how their economy works, you will be able to, leverage and get more out of it. So the H1, what we have seen right now, and as outlined by us earlier, we did see some challenges in the global economy, due to which that's where you've seen we also outlining that as a reason where we have seen a muted growth in the knowledge services. So that piece is correct. But having said that, I do believe that Moody's did have a good quarter, the last quarter at least. And I'm not saying that we don't give a forward looking, but that gives us some hope that the 15-20% whatever is left or possible on the table, there could be opportunities for us. So it's not that plain that the headcount addition doesn't happen means this just gets backed over. You still have an ability, and depending on how we are able to see that transaction, we will be able to leverage and get out of it. So the answer is, it's not that the headcount itself will play, but there is a project part also which will help us grow.
And also, in the knowledge services business particularly, as you rightly said, the headcount or the addition to headcount is a lead indicator. You must also understand that there is a lag between the headcount build out and the actual, business delivery. Because the way these contracts typically, evolve is, first we get an indication as to how many people will be required. We go through a proof of concept, which could be, a 4-month affair, or it could be 6 months or 8 months. Once that is actually done, and depending on the results and the efficiency of our delivery, the actual contract gets awarded. So the monetization of that could take place, either 4 months or 6 months or 8 months after initiation of the headcount build out. So there will be a lag. So it is a lead indicator, yes, but the lag could actually be, some months.
Okay, sure. So does it mean that, for the projects that we would be expecting, say, in the H2, we have already built out the headcounts last year itself, because the lag could be, say, 6 to 8 months in some projects. Is that the right understanding?
It's entirely a function of when the proof of concept actually, the exercise starts. So it could happen at the start of the year, it could happen in the middle of the year, it could happen towards the end of the year. So it's entirely a function of when the need actually gets expressed to us by the other party. It could be Moody's, or at the moment is Moody's, but it could be anybody else as well.
Sure. And last question, if I can squeeze in again, is on the non-Moody's part of non-rating business. We in one of the interviews earlier, we had said that in next 5 years we expect that business to grow at a much faster rate. So can you throw some light on that part of the business, both in terms of the revenue trajectory and also in terms of profitability? Because if we look at last 3-4 quarters, the profit drag from X of knowledge services in non-rating has been increasing. So if you can talk about the growth trajectory part and the profitability part in non-rating business X of Moody's or knowledge services.
Sure. JC, would you like to take that?
Yeah. So X of Moody's, as you mentioned, there are two businesses. One is market data and one is banking and risk management. So in market data, we are providing valuation to AMCs in India, and this is going on a daily basis, and that's something which is used by the fixed income business, for valuing their portfolio. The other services that we have started in market data is in terms of rating trackers and treasury solutions, which are seeing traction as we move along, and not only in the mutual fund segment, but also in the corporates and the AIFs. We are seeing good traction coming from these products. So while you did mention that there is some kind of a slower growth that you are witnessing and some margin pressure that you are witnessing there, I would like to mention that the segments that we are addressing now and the areas of growth that we have selected, we should see much better performance in this market data as we move along. We have also mentioned that we have tied up with certain global data providers like Bloomberg, FactSet and ICE, and that should also see increasing revenue as we move forward into the coming quarters. The other thing is on banking and risk management, I would agree with you that traction has been a bit slow, but we do expect that with impending regulation coming from banking segment on ECL provisioning, there is a big opportunity which is lying there. In addition, NBFCs already have moved into ECL norms, and we are seeing good traction in that business as well. So even in the banking and risk management part, we expect that traction should be much better as we move forward.
And this is an area again where we believe that the current acquisition that we've announced, D2K, that will add, significant value.
Sure. And this D2K, they did some 15 crores of revenue last year. What would be the, ballpark profits that they did, or it was not making profits?
So it has been profitable since the time it was set up.
Sure. Will you be able to share some, indicative number on the kind of quantum of profits that they made in FY23?
So at this point in time, this has not been disclosed to the exchange, so we are a bit cautious. But having said that, we can just say that it's a profitable. It has been profitable till last year.
Sure. Thank you so much for answering my questions. I'll get back in the queue. All the best.
Thank you. Our next question is from the line of Paresh Sangani from Club Millionaire. Please go ahead.
Hi, thank you so much.
Sorry to interrupt, Mr. Paresh. Your audio is muffled, sir. Could you please use your handset, please?
Hi, Ram. This is Paresh here. First and foremost, thank you for the quality of presentation. It's really gone up and it's insightful now.
Paresh, you're not very audible, Paresh.
Mr. Paresh, you're not audible.
Is it better now?
Yes, sir. Please go ahead.
Yeah. First question is on the rating margin. I was a bit surprised with the sequential drop, simply because this quarter we would have had the highest securitization volumes, ever. So obviously, this being a high margin product, ideally our margin should have either held up or gone up. So just thoughts on that, Venkat?
So, Paresh, just one thing, typically if you look at rating margins as such, the rating revenue growth has been a bit lower in Q2 as such. If you look at the way we do, either most of the time if you look at the earlier quarters also, we would have at least grown 11% plus. The Q2, we believe there was a challenge as outlined by Shiv earlier. We did see that there was a degrowth in both the bond market and the bank credit both. So we did see a lower percentage revenue growth, which in a way had some impact on the margins. But I think the better way to look would be at an H1 level where we have seen, at least a slight uptick in the margin. And we do hope that in the next 6 months, if the credit growth holds up, I think the numbers should, it should get reflected somewhere. But the Q2 was a bit dampener, especially at the market level.
Okay. So within the rating space itself, in terms of revenues, a couple of factors. We see US interest rates hitting all-time highs, with a 5% yield over there and the rupee depreciation happening. Would you expect a lot of refinancing to happen from Indian corporates from the Indian domestic sources? So therefore, would you have a faster banking credit growth happen? And the second aspect within that was, we had seen about 20,000 odd companies across the credit rating space who had stopped rating completely about 4 or 5 years back, or maybe even 6 years back, right? With the credit scenario being very benign, are you seeing any signs of them coming back to the credit market? I mean, in terms of credit rating?
Yeah. See, we agree with you on this point. Domestic borrowings would be more economical, very clearly. That's a trend we've seen for more than a year now, ever since the Russia-Ukraine conflict broke out. So that trend continues. On your second point, yes, you are right that a lot of corporates are deleveraged significantly right through the pandemic phase. We do expect them to come back and borrow, but at the same time, these corporates are a lot more cautious today in terms of the investments they do, the timing of investments. All this is a function of what kind of demand they see. But we are indeed seeing a pickup or the early signs of pickup in private sector capex. Some sectors are already seeing it, for example, in steel, and there are entities which have enhanced the borrowing limits. So you're right. On both the points, you're right. It will get played out over the next couple of quarters.
Okay. And within the analytics space, right, I saw in the presentation you mentioned that there is being a collaboration or you're looking for a collaboration with leading global data providers for value-added services, right, within the knowledge services space, which is apart from Moody's. So were you referring to Bloomberg Factsheet and something like this? And can you talk a bit more about this in detail?
Yeah, I'll take that. So essentially, in the case of FactSet, we are providing them with valuation data, which will be firing their attribution tools. FactSet has a lot of attribution tools which are used by their customers. So in order to use those tools, they need valuation data. So we are providing that data to them, and this will be used by FactSet clients to fire their tools at their end. So this is something that we expect will pick up the utilization of this will pick up as we go along. The trend might be a bit slow initially, but as and when the familiarity grows, we expect this to pick up quite well in the coming quarters. So that is on FactSet. On Bloomberg, similarly, our valuation data for fixed income securities is now being made available through the Bloomberg terminals for all their users. And that's also something which we expect will add to our revenues as we move along, because Bloomberg has a good market share in this space. And moving forward, that should be something which will add a lot of traction to our own market data services and products that we offer. As far as ICE is concerned, we used to provide ICE with security level valuation for corporate bonds. We are now moving into state development loans as well, and that's something that should get formalized, and usage of that we expect to pick up quite well going forward. So these are the three tie-ups that we have done. And while we were very strong in the AMC space domestically, we expect that these tie-ups should take us into the global markets as well through these data and service providers.
So just to clarify, this tie-up that we have with them, is it both for domestic as well as their international business? How is it normally?
Yeah. All the terminal users, both global and domestic.
Okay. And then final question is regarding the D2K acquisition, right? From what I saw within the presentation and the disclosure, it looks like it was a product offering which is similar to what we already do within our RMS side. So how is it very different? I mean, I'm sure we would have had a product, something on these counts already. So how is it really different in that sense?
No, it's only complementary to what we do at the moment. So if you look at the two main products that are there, in D2K, one is the early warning, alerts that they provide to the lending institutions, aggregating, number of multiple, data points. We don't have that product in our product suite at the moment, though we have been thinking of actually developing it. Now we don't need to. The other one is they have the income recognition and asset classification, identifiers, again, that they provide, to lending institutions, but primarily, banks and NBFCs. Again, something that we do not have. So they are complementary to what we have, and these are not, they will not cannibalize any of our existing, revenue streams.
Okay. And Ram, just one final clarification. These will be on what, on SaaS basis that will be provided to the customers? Sorry, come again? The pricing will be on SaaS basis or something similar to a customer?
Yes. Both on SaaS and on-premise. Both solutions will be there.
Yeah. Sorry?
So software as a service as well as on-premise. Both of them will be there.
Both. Okay. Fine. Thank you so much, Ram, and all the best. Thank you.
Thank you.
Thank you. Our next question is from the line of Mahesh Purohit from HJ Securities. Please go ahead.
Good evening, everyone. Am I audible?
Yes, sir. Please go ahead.
Yeah. So my first question is regarding the analytics business. We did a acquisition this quarter. So is it proper to understand that in the analytics business, especially the non-Moody side, will we be doing more acquisitions in the coming years?
So sorry, that's a new PSI, so we can't answer that.
Okay, but will that be one of the strategies for growth in the future?
I think it's fair to say that we will constantly be on the lookout for opportunities, and as I said, if it actually ticks all the boxes, both organic and inorganic, and if it ticks all the boxes that I had actually talked about earlier, then naturally it will receive serious consideration.
Okay, fair enough, sir. Thank you. And my second question is about the ratings business. So we are seeing decent growth in the Indian GDP and also the government capex on infrastructure, and also we are expecting private capex to pick up. So considering all that and also the expansion of the bond market, so could we expect a better growth rate in the ratings business over the next 5 years?
The ratings business is always going to be, it's a leverage play on how the, market activity pans out, right? So it's a function of how the spends pan out, and it's entirely a function of that. So, I think it's at the present time, as we've seen, in the first half of this year, the ratings business has seen revenue growth of just a little north of, 11%, right? So, but it's always going to be a function of how the market activity, how the credit offtake, how that actually, builds out. So, the spends will have to kick in. In the first half of this year, it has been largely state-led, and the private sector spends have been still fairly muted. And once that also kicks in, I think, it should play out, quite well. Shiv, anything else that you want to add?
Yeah, I agree with you. We've seen this play out, last couple of quarters very clearly. We do expect, these two segments, particularly infrastructure, and led by infrastructure, domestic consumption, and hence the BFSI space to grow quite significantly in the coming quarters. But that's, again, as laid out by the government in the union budget for this year, and going ahead, it is logical to assume that these segments will pick up well. So, as I mentioned, we do look at these segments and growing well, and Icra leveraging on these opportunities.
Okay. Thank you. Thank you.
Thank you. Our next question, ladies and gentlemen, the last question for today's question and answer session is from the line of Pritesh Chheda from Lucky Investment Managers. Please go ahead.
So I just have one question on the India rating business, and I don't know if it was asked earlier. So the quarter gone by, have you lost any market share, or was there any pricing pressure in the market? If you could comment on these two aspects.
Yeah, this question was indeed asked earlier and answered. I'll just repeat it in a brief way. The difference largely which you see between Q2 and Q1 is because of the market headwinds, particularly the bond issuances as well as the bank credit. Our approach has been stable, and our position also largely has been stable.
Okay. And any incremental pricing concerns or anything that you see in the market?
There is nothing which differentiates this quarter from the previous quarter. As I mentioned, those drivers are by and large the same. It was more the market headwinds.
Okay. Thank you very much.
Thank you. Ladies and gentlemen, that was the last question of our question and answer session. As there are no further questions, I would like to hand the conference over to Mr. Venkatesh Viswanathan, Group CFO, for closing comments.
Yeah, thanks. We have come to the close of the analyst and investor call. On behalf of Icra management, I thank all the participants for their time and the insightful discussion that we had today. Thank you.
Thank you. Ladies and gentlemen, on behalf of Icra management, that concludes this conference call. I thank all the participants for joining us. Thank you.